It's Friday morning, June 2nd, around 9 a.m., and the jobs report came out at 8:30, and the report was spectacular. There were 339,000 jobs actually added, so the labor report was really stellar, and that caused the market to move up and down, to gyrate up and down, and settle just about where they were prior to the report, but they moved up and down 25 points at 8:30. And as you can see, the market is trading at 9 a.m. just about where it was prior to the labor report. Now, I calculated where the market was likely to trade based on the Taylor trading calculator, and I calculated the market was going to trade somewhere in the area of 42.40 to 41.88, so about a 50-point range is where I figured the market, or I calculated the market should trade, but with a resistance at 42.40 and support down at 41.88, and the market's trading well above that. So as the market opened, prices moved up, and actually that sort of made sense, being that the Labor Department report was so spectacular, indicating that the economy is moving ahead nicely. But I want to know where the market is likely to trade, and chasing the market I know to be a mistake. And so I like to use the Taylor calculator as a guide. If prices trade outside the calculator, well, I'm not going to argue with prices. But I do want to have some kind of an edge to see where prices are going to trade. So when prices opened up, when the market opened up at 9:30, the market, I don't have a crystal ball. The closest thing that I have to a crystal ball is the Taylor trading report and my 20 years of experience as a trader. And looking to chase the market, it sometimes works. Look, anything could work as a trader, but I want to have that edge. So I'm going to wait a bit to see what happens, because I figured that the market is going to trade, or should trade, down in the area of my trading zone, which, and I can't find prices. So I'm going to wait and look to see where prices are likely to trade. So I'm waiting, and prices at 9:45, prices reach a sort of not an inverted hammer, but they reach a top at 42.73, and I'm not in the market, but I see prices at 42.73. They correspond to an overbought stochastic, so I figure prices should go down there. So that's a good place to place a trade. Okay, so again, I didn't trade. Prices are going down because, again, chasing the market, prices are going down, and I'm saying, well, maybe the gap will close. The gap is down here. This is Thursday's close at 42.28. So the gap is likely to close 75% of the time. The gap closes. So will it close today? Well, it's a good chance it will, but let me see. Okay, so now at 10 o'clock, a hammer, a very sharp hammer, a very visible hammer shows up, corresponding to an oversold stochastic. But there's something else here. This hammer could be, and I'm waiting, prices move up. This hammer could be the intraday low, possible. And this inverted hammer here, or this blow off, could be the intraday high. So either one of those two things is possible at 10 a.m. Fast forward to 10:30. Now at 10:30, the market had risen back up to 42.66, didn't take out the intraday, what had been the intraday high at 42.73, but then backed off to 42.57, which did not take out the intraday low at 42.48. After that 10:30 candle at 42.57, the market continued its climb upward. Now, at this point, it looks like the market is going to actually continue up for the day. Now, at this point, I can make a judgment. The market, again, there's 5 points between each horizontal line. 5 points, okay? And the calculated range is 50 points. So the market has traversed 20 points throughout the day up until 10:30. And I know that the market has probably got another 30 point of range built into it. In which direction is it going to go for those 30 points? So what I'm going to do then is move and looks like the market is not going to trade down to my trading zone. So what I'm going to do is I'm going to copy my trading zone and I'm going to move it up to the intraday low, to where the intraday low was, right at 42.48. And I figure based on that, the market should trade up around 4,300 around there. And so it looks like if the market does continue up based on this hammer being put in at 10:30, at 10 o'clock as the intraday low, it looks like the market is going to continue trading up. And that is my edge. And that's where I make my trade. And so this gives me the knowledge of basically where the market is likely to trade based on the stochastics, based on the range. Certainly, the calculated trading zone was useful to the extent of calculating a 50-point range. And the market actually traversed 48 points for the day. So 48 points versus a 50-point calculated range, that's pretty much a good way to make an assumption of how to trade. So that's my video for today. Thoughts of a trader. This is hypothetical, my friends. Of course, this is after the fact, but I just want to give you some insight as to how to trade, how to put the edge in your favor, and not to chase the market. I mean, you could chase the market, you can be right or wrong, but always look for the edge if you can. So that's my video for today. Thanks so much for watching. I'm Marv Eisen of Timeless Dollar Trading Academy. Trade safely, use lots of patience, and I'll see you in my next video.